Hello, welcome back, guys. So, Nike today had its earnings report and things are looking dire. The stock is actually down about 13% right now as the market opened about 10 minutes ago or so. It's sitting at 95 bucks, as you can see, and its 1 year high has been 180. If you take it back about 5 years, you will see here that the company stock price has been going down recently. And it may be an interesting actually valuation right here again after it has been going down significantly from its highs. Now we're going to examine that in more detail, of course, in this video, see exactly what has happened. But before we begin our analysis of the stock financials, we are going to take a look at, of course, what happened during the earnings report. So let's take a little bit of a look here. First of all, Nike promises decisive action on inventory, more investment in D2C. And you will see here that one of the core reasons why Nike went down is the excess inventory that the company had. You will see here that from sales in China that fell 16% to North American inventories that jumped 65%, to strong dollar headwinds that whittled 10% revenue growth down to 4%, to container ships and orders that came too slow and then too fast. The past 3, 6, 9, and 12 months have delivered a bear market and an unprecedented calm down. Now, as expected, we did know about all these potential issues. Obviously, Nike is a strong international company and has a lot of its revenue coming from the international markets. And of course, with the dollar being much, much stronger than the other currencies, and all of them, especially the euro, going down tremendously, you are going to be seeing the company suffering from international pretty much currency issues over here. Now, the thing is, the company also had extra inventory, which we're going to examine in a little bit more detail. But the problem with extra inventory is it has multiple aspects, really. The fact that you are actually spending extra free cash flow, you're actually spending money to buy inventory that you cannot move is a big, big problem. Also, inventory gets depreciated, and then you also have to potentially give it at a discount. So there are tons of issues. You really, really want to be having enough inventory to satisfy needs, but not too much that you cannot sell. So this is very, very important here. Now you will see that while strong consumer demand for full-price Nikes and etc. pretty much triggered early ordering by retailers, the unpredictability of delivery times caused in-transit inventories to swell 85%. Now at least that's good. What they are saying here is that demand hasn't really gone down, and it's mostly like a supply chain issue here is what they are saying over here. Now, to be sure, although Nike's earnings were down 20% and its low single-digit sales growth is a fraction of what it was, not all the many global retailers and brands can move 12 billion worth of merchandise in 90 days. So they are saying that the company is still making quite a lot of sales here. Now let's take a closer look at the exact numbers here. So the Q1 results, this is a blue chip on sale is what they're saying here, but is that the case? We're going to see. Now inventory was up 44% on average pretty much as well. Now, Stephanie Link recommends buying Nike stock, especially if you're a long-term investor. Again, we're going to examine that in more detail with our tool, of course. You don't just listen to what everybody says here. And you have to wait a quarter or two to get inventory to run down, of course, at least I'd say. But to me, it's a quality name on sale. And if you are selling it on this quarter, that's silly because you really want to own this for the next 3 to 5 years. That's a blue chip on sale. Again, that's what they're saying, but that's not necessarily the case here. There is a consensus overweight rating on shares of Nike that's now down more than 45%, it's actually closer to 50% right now. Net income at about 1.5 billion versus the year ago 1.9 is the 20% decline that we talked about. Per share earnings tanked quite a bit from 1.16 to 93 cents. Sales went up 4% on a year-over-year basis, so we're having a 4% revenue growth here. Consensus was 92 cents of EPS, and gross margins contracted 220 basis points to 44.3. So, in terms of other notable Nike figures here, you will see that there is a 16% decline in revenue from China, which I believe is about the same overall sales that they're doing. It's about 15 to 16% is their sales from China, pretty much. Was partially offset by a 13% increase growth in North America. The footwear and athletic apparel company returned roughly 1.5 billion to shareholders. Now let's take a look at the actual financials of the company, because that's what eventually matters. And again, it has gone down almost 50%, actually more than 50% after today's decline, I believe. And actually, no, it's not more. It's about that, actually, yeah. It's already factored in. And you will see here that the P ratio of the company currently, that's the current one as it's dropping right now, it's sitting at 24.4, 25.4, and the price to free cash flow at 33.8. So it's still not cheap. So it's sitting at 25 times earnings here, which is still not cheap for a retailer. Now you may be arguing that this is a quality retailer, and that's true. That is a quality retailer, but still the price of its earnings, it's still a little bit more expensive than what we would like. Now the company has been buying back some shares. We do want them to buy more, and it's a pretty solvent one too. Little debt over here, as you'll see. 5-year revenue growth that is growing, but it's going to be stalling a little bit is what we saw. At least it's going to be growing at a less pace pretty much. Net income that grows very nicely over here, and free cash flow that's also growing along with the total equity. The price to sales has also been going at levels that are not bad at all over here, frankly. So it's actually going less and less. That's because of the stock price going down, of course. And the net income margins, again, sitting at about 12% over here. Slightly dropping a little bit, but very slightly. In terms of returns, we're looking nicely here, return on equity of 37%, and the company is paying 1.3 almost in dividend yield, as you'll see here, which is a payout ratio of about 43% in terms of its free cash flow. Easy to actually give out for at least a few years from now. So yeah, that should be fine. We can always take a little bit of a closer look to see how dividends have been doing. They did have a little bit of a decline here. So their dividend yield, currently the effective one at 1.28, is not much dividend, and the thing is the payout ratio is already high. So you won't be seeing too much of a payout here. So I wouldn't expect this to go like 2% and still be rather safe, because when we're taking it to, let's say, 2.4%, now we're talking about an 80% payout ratio more actually. Of course, the company will hopefully be growing its free cash flow as well, but you can see right now that this is not a super easy situation here for the dividends. It's still easy to pay them, but they cannot go too far with that. So that's something to note over here. And remember also that this is a retailer, so you can be expecting fascinating growth as well, usually at least, even though this company has been growing at a relatively nice pace, after counting the fact that it is a retailer and they tend to not to grow too much for the most part. And their margins are not horrible either. If we take it to the financial statements, you will see that they have been growing their revenues. Now we do know that the latest one is going to be a little bit of a burden here. Their net income has been growing as well. And also, if we take a look at their balance sheet, you will see that the total liabilities are sitting at about 25 billion over here, with a total equity at 15.2 in terms of their pretty much total assets minus total liabilities. Now, if we take a look at their cash flow, you will see that last fiscal year it was like 4.43, which is about 4 to 5 in terms of the total liabilities multiple. Over here, if you multiply that, you get the amount of total liabilities. So this is relatively solvent for the company. It should be easy for them to pay all their total liabilities if they really wanted to, which is a good thing, of course. It's a solvent company. Now, their net income has been growing along with their operating cash flow, even though, remember, inventory is the thing. They bought a lot of it, and so you are looking at the effects right now. However, you will see that the free cash flow is still, for the most year, sitting at about 6 billion over here, 5 to 6 billion. So that's not negligible. And sitting at a 5 to 6 billion, if you go back at our stock analysis page, you will see that the company's market cap is at 150 over here, which is in about 33 if you do the division pretty much. You will take this number, you will find this number over here if you multiply the cash flow. Okay. It is a little bit expensive, but how expensive, our stock evaluation tool is going to tell us exactly. Now, we do know that the company's revenues are likely going to be suppressed, so I'm going to be going a little bit lower. Let's go 2, 3, and 4%, even though the company could be having some years that are better. And in fact, I was looking at analysts and they are projecting like 6, 8%. Now, I don't know if this is going to happen because with analysts, you never really know for sure, but I'm going to go a little bit more conservative here. Now, their net income margins, I'm going to go 10, 11, and 12 over here, which does make a ton of sense. And in terms of free cash flow margins over here, sitting nearly 100%, 80, 90, and 100, and an annual return of 13% is what I'm going to be trying for. And let's hit calculate here and see what we're getting. And as you would expect, this is an expensive company still. And even though you're looking at these articles talking about how this is a blue chip on sale, I still feel that it is expensive, and especially for it being a retailer. I would probably like to get it at less than $50, frankly. potentially even 40, potentially even less than 40, especially in this current market situation. I would be actually a little bit scared to be holding Nike right now. I think it has the potential of going lower and pretty soon, frankly. We'll see though, of course. But regardless of what I feel, the company stock price is still expensive for what it is. So I think I would stay away from this one right now, even though it has this massive discount. But thank you for watching. I hope you enjoyed this video. Tell me what you think about Nike. Leave a comment below. And remember to like and subscribe. And as usual, you can become a patron and get access to our tool here. Just find the link in the description box below. And I'll see you inside. See you soon in the next video. Bye bye for now, guys.